Section 4.2 Contingent Claims. The holder of a contingent claim has the right but not an obligation to make a final payment contingent on the performance of the underlying. Here again, a contingent claim is a contract. At time 0, two parties, say A and B, sign a contract for a transaction to take place at a point in the future, time t. But the difference here is that one of these parties, the party that holds the claim, has the right but not an obligation to make a payment on this date and get the underlying. Since this is not an obligation, we can also call this an option. And frequently the terms contingent claims and options are used interchangeably. The curriculum talks about three types of contingent claims: options, and this is where we will largely focus on, and then credit default swaps and asset-backed securities. Let us talk about options first. An option is a derivative contract in which one party, the buyer, pays a sum of money to the other party, the seller or writer, and receives the right to either buy or sell an underlying asset at a fixed price, either on a specific expiration date or at any time prior to the expiration. There is a lot of information over here, and I will explain this through an example. Let's say we have two parties, A and B. A is the seller, also called the writer, also called the short party. B is the buyer or the holder, and also called the long party. These two parties sign a contract which says that B has the right to buy an underlying asset at time t for $50, but not the obligation. The underlying asset, let's say, is XYZ stock, one share of this. The expiration time t, let's say, is 6 months, and the price that party B will pay is equal to 50. This is optional. In other words, B has the right but not the obligation to buy the underlying, which is XYZ, for this price. If B decides to buy, then A has to sell at this price regardless of what the underlying is actually trading for. Now, we'll go back to the definition and connect this definition with the example. An option is a derivative contract in which one party, the buyer, that is party B, also called the long, pays a sum of money to the other party. Now, for this contract, clearly B is the one that will benefit. B has the option, not the obligation. So B will pay a certain amount. Let's say that that amount is $3, and what I'm actually describing here is a call option, and we'll talk about this in more detail later. This is called the call option price. To get the option, B is going to pay $3 to the seller. In return for paying this $3, B receives the right to either buy or sell an underlying asset. In my example, B is buying the right to buy the underlying asset at a fixed price, which is 50 in my example, either on a specific expiration date or at any time prior to the expiration date. In my example, B will buy at the end of this period, so at expiration date. This is called a European style option. If the contract is defined such that B can buy the underlying at any point, then this would be called an American style option. And this material will be covered in a tremendous amount of detail later in the reading on options. What I'll do here before I move on is quickly draw some payoff diagrams. You will see the diagrams here and you'll see them later. They are important enough that it makes sense to do this material twice. Let us talk about a call option first. A call option gives the holder the right but not the obligation to buy the underlying at a particular price. Let's say that the long paid $3 and the strike price is 50. Strike price is the price that the long party is going to pay in order to get the underlying. And again, this is optional. If the long decides not to pay or not to exercise, that is up to him. What does the payoff look like? With the payoff diagram, we draw the different, or we indicate the different stock prices on the x-axis and the payoff is on the y-axis. We first mark the strike price of 50. If at expiration the stock price is 60, then what will happen? The long party will exercise the option, buy the stock for 50, but the stock has a market price of 60. If the long wants, he can sell that stock for 60, which means he makes $10. So the payoff at expiration is 10. If the stock price is 70, then the payoff will be 20. So the payoff diagram looks like this. If the stock price ends up at 40, then the long party or the holder of the call option will not exercise the option. He will not buy the underlying for 50 because he can buy the underlying in the market for 40. So the payoff here is 0. This therefore is the payoff for the long call. What about the payoff for the short call? As with forward contracts that I talked about earlier, options are a zero-sum game. Any gain for the long has to be a loss for the short. This $10 that the long is getting must come from the short party. So the payoff for the short party will look like this. If the stock price is 60, the short has to effectively pay 10. If the stock price is 70, then the short has to effectively pay 20. So this is the payoff for the short call. What about the profit? Remember, to get the option, the long party had to pay $3. In terms of profits then, the profit diagram will look like the payoff, but it will be $3 lower. Let me draw the profit diagram in blue. This is what the profit diagram will look like, and generally the profit is denoted by a big pie. If the stock price ends up at 50 or lower, then the profit is -3. In other words, the $3 spent here are lost. If the stock price goes up to 53, then the long party breaks even because the payoff is 3, but that payoff just compensates for the $3 that were paid for the call option. Only if the stock price goes above 53 will the long party actually make a profit. The profit diagram for the short party will be a mirror image. So this is the profit for the short. What I have talked about here is a call option. We can also have put options. A put option gives the holder the right to sell an underlying asset at a given price. Let's say that given price is 50. This is called the exercise price or the strike price. Clearly the holder of this option has to pay some money to get the option. That is denoted by a small p. Let's say that that small p is equal to 2. By paying $2, the holder of the put option has the right to sell the underlying for 50. Clearly, a put option will be valuable if the underlying goes down, because if the underlying goes down, then the right to sell at a high price is valuable. On the other hand, if the underlying goes up in price, then the right to sell the underlying for 50 is not valuable. So let's draw the payoff diagram for a long put now. Again, we'll assume that the strike price is 50. This is what the payoff looks like. The x-axis represents different stock prices, and in red we are drawing the payoff for the long put. If the stock price goes down to 40, then the payoff is 10, because the long party can buy the asset in the market for 40 and sell at the strike price of 50. If the stock price goes to 60, then the put is worthless. The long party will not exercise the option to sell for 50. The payoff for the short is simply the mirror image, and the profit diagrams look like the payoff, but for the long party the profit diagram will be down by 2 units, and for the short party the profit diagram will be above this by 2 units. I will repeat the fact that this material is covered in a lot of detail in the reading on options. So if you did not fully understand this over here, don't worry too much. You can come back to this section when you are done with the reading on options. Next we come to credit derivatives. A credit derivative is a class of derivative contracts between two parties, a credit protection buyer and a credit protection seller, in which the latter, which is the credit protection seller, provides a protection to the former against a specific credit loss. This is called a contingent claim because this payment or protection is contingent upon a particular loss happening. And since the losses are related to credit losses, that's why these are called credit derivatives. There are several types of credit derivatives. The curriculum talks about a total return swap, credit spread options, credit linked notes. But the most important type of credit derivative, and the one that you are most likely to be tested on, is a credit default swap. A credit default swap is a derivative contract between two parties, a credit protection buyer and a credit protection seller, in which the buyer makes a series of cash payments to the seller and receives a promise of compensation for credit losses resulting from the default of a third party. In a sense, this is like an insurance, and let us understand this through a simple example. Say we have party A and party B. Party A lends money to party B. This means that A faces credit risk. Party B might default, and the risk of that happening simplistically is called credit risk. In order to protect itself against credit risk, what party A might do is contact this other company and buy protection. In this case, party A is called a protection buyer and party C over here is called a protection seller. In order to buy this protection, party A will pay a premium, and you can think of this as an insurance premium where party A needs to pay this premium on a routine basis. It might be quarterly or annual, and in return party A is getting protection. This contract will have credit events defined. So the contract will specify that under so and so circumstances, typically relating to this party defaulting, the protection seller will then compensate the protection buyer. So as I mentioned before, this is effectively like insurance, where if this underlying does not perform, in the sense that party B, which is supposed to make coupon payments and then the final principal payment, if this party defaults, that would be a credit event. And if that does happen, then the protection seller will compensate the protection buyer. If party B keeps making its regular payments, then party C is happy because party C gets its regular premium payments from the protection buyer. Now notice why this is a contingent claim. This is a contingent claim because the money received by A is contingent upon certain credit events happening. Specifically, this payment is contingent upon party B defaulting. Now let's look at some questions which are from example 4 in the curriculum. An option provides which of the following? Either the right to buy or the right to sell an underlying, the right to buy and sell with the choice made at expiration, the obligation to buy or sell, which can be converted into the right to buy or sell. The correct answer is A. The right to buy is a call option, the right to sell is a put option. So either we'll have a call option or a put option. So that is correct. The right to buy and sell, this makes no sense. The obligation to buy or sell, with an option, by definition the holder has an option. So the moment we start using this term obligation to buy or sell and then convert into the right to buy or sell, this also actually makes no sense. So the correct answer is A. Which of the following is not a characteristic of a call option on a stock? A guarantee that the stock will increase, a specific date on which the right to buy expires, this is a characteristic that we talked about, a fixed price at which the call holder can buy the stock, so this implies the option, this also is a characteristic. The correct answer therefore is A. A credit derivative is which of the following? A derivative in which the premium is obtained on a credit, a derivative in which the payoff is borrowed by the seller, a derivative in which the seller provides protection to the buyer against credit losses from a third party. If you are paying attention on the previous slide, it is quite obvious that this is the correct answer. Asset-backed securities. This topic is generally covered under fixed income securities, but asset-backed securities also have characteristics of derivatives, so we will talk about this material very briefly over here. Before we read the definition, I just want to give you the basic concept. Let's say we have a particular financial institution which creates a portfolio of mortgages. These mortgages are assets for the financial institution because this particular institution now gets payments associated with these mortgages. So the homeowners make mortgage payments. These mortgages are assets. The financial institution effectively has created a portfolio of these mortgages. Against these mortgages, the financial institution issues several securities, and these securities are called tranches. The idea is that the payments that come in, or these mortgage payments which come in, are redistributed to the various securities. An important characteristic of asset-backed securities is that these payments that are coming in are distributed based on certain rules. Some of these securities are defined as junior tranches, others might be defined as senior tranches, and what is happening here is that prepayments and credit losses are being distributed differently. Junior tranches will typically receive prepayments before the other tranches, and the point here is with mortgages sometimes there will be prepayments, and who gets those prepayments? The answer is that these tranches or securities are defined such that the junior tranches receive prepayments first and senior tranches receive prepayments later. What about credit losses? Junior tranches will face credit losses first, and then credit losses will move on to senior tranches. So notice that the senior tranches are somewhat protected by the junior tranches. This was just a high-level explanation. You will see this material in a little more detail in fixed income and then in a tremendous amount of detail at level 2. Now you might be wondering why we are talking about asset-backed securities in derivatives. The answer is that the value of these asset-backed securities or tranches is derived from the value of these underlying mortgages, and therefore we can also think of these as derivatives. Now let's look at the formal definition from the curriculum. An asset-backed security is a derivative contract in which a portfolio of debt instruments, and here the mortgages are the portfolio of debt instruments, is assembled. That's what's being done here. And claims are issued on the portfolio in the form of tranches. These securities that are issued, these are the claims that are issued. And these claims have different priorities of claims on the payments made by the debt securities. So these securities have different priority of claims against the payments which come in, such that prepayments or credit losses are allocated to the most junior tranches first and the most senior tranches last. And that briefly is what I spoke about earlier. I don't think you will be tested on the details of this material over here. The idea is to just get a high-level sense for asset-backed securities. One final point, asset-backed securities have several names. You will hear the term CMO or CDO and so on. And these names are based on the type of portfolio that is created. If our portfolio consists of mortgages, then the asset-backed securities are called CMOs or collateralized mortgage obligations. If this portfolio consists of various kinds of debt instruments other than mortgages, then this would be referred to as a CDO or collateralized debt obligation. Hybrid instruments combine derivatives, fixed income securities, currencies, equities, and commodities, and that's why they are called hybrids. A classic example is where we can combine an option and a bond to create what is called a callable bond or convertible bonds. We will see this material in fixed income securities. Now let's look at the questions in example 5 from the curriculum. Which of the following is not a forward commitment? Notice that we are looking for not. An agreement to take out a loan at a future date at a specified rate. This clearly looks like a forward commitment and is therefore not the correct answer. An offer of employment that must be accepted or rejected in 2 weeks. Notice here there is a choice. The offer can be accepted or rejected. Because of this choice, this is not a forward commitment. This looks more like a contingent claim. So this probably is the right answer, but let's look at the third option also. An agreement to lease a piece of machinery for 1 year with a series of fixed monthly payments. This looks a little bit like a swap, which is a forward commitment and is therefore not the correct answer. The best answer is B. Which of the following statements is true about contingent claims? Either party can default to the other. Notice that this is not a true statement because the party that buys the claim, and when you think of contingent claims, the best category to think of is an option. The party which buys the option or the holder of the option cannot default because that party has the option. The other party which sold the option might default. The payoffs are linearly related to the performance of the underlying. This is not exactly true, because if you recall the payoffs, let's say that the underlying is a stock, the payoff looks like this. So it is linear after a point, after this strike price, but it is not linear across the board. So this also is not correct. The most the long can lose is the amount paid for the contingent claim. This looks correct because the amount that the long can lose is the amount that this party paid for the option. So the worst case scenario is that the amount that was paid for the option is lost. After that, there is no other loss. So C is the best answer. Derivatives underlyings. We have talked about the fact that a derivative is a contract or an agreement which derives its value from an underlying. Let's talk in a little more detail about what are the different kinds of underlyings. One of the most common type of underlying is a stock or equity. In fact, with equities, we have two broad categories. The underlying could be a particular stock, or it could be a stock index. We've talked about a very simple type of call option where the value of the call option is based on the value of the underlying stock. The underlying could also be a fixed income instrument such as a US Treasury bond or note. But there are issues with using bonds as the underlying. I just talked about the underlying being a US Treasury note. The question then becomes which particular US Treasury note, because the US Treasury issues several notes. And as we will see later in this course, the contracts where a bond is the underlying are often structured such that the short party has the option to deliver one of several bonds. Next we come to interest rates. And while interest rates are obviously related to fixed income instruments, but note that here the underlying is not really an asset. And that is why very often in the curriculum as well as in books on derivatives, the underlying is simply referred to as the underlying as opposed to saying the underlying asset. And you might recall early in our lecture, in the definition of a derivative, I used assets in parentheses because interest rates are one of the most popular underlyings, and interest rates are obviously not an asset. In the US dollar context, a commonly used interest rate is LIBOR. Next we come to currencies. Clearly, currencies can also be an underlying, and you have forward contracts, futures contracts, options based on currencies. The contracts can be simple or they can be fairly complex. The underlying could also be commodities such as gold or agricultural products and so on. The underlying could be credit. Remember, we talked about credit default swaps. We talked about CDOs. Here the underlying is credit of some form. And then we have several other types of underlyings, for example, weather, electricity, and so on. You don't really need to get into the details here, but just recognize the fact that contracts can be based on several different types of underlyings. The purposes and benefits of derivatives. Before we get into the specifics, let's take a look at how the Chicago Board of Trade was formed. Let's say this is the United States and this is Chicago. In the mid-19th century, Chicago was becoming a hub for agricultural products. Farmers in different parts of the country, generally in the Midwest, would bring their corn and their wheat and their soybean to Chicago and sell it over here. The problem was that most of the produce would come to Chicago at roughly the same time. If in a particular season the crop was really good or the quantity was high, then the prices would fall. In other seasons, if there was a shortage of produce, then the prices would be very high. So there was a considerable degree of volatility in the market for agricultural products. In fact, there were times when the prices would be so low that it was more cost effective for farmers to dump their produce into the Chicago River as opposed to taking it back. Some businessmen saw this volatility and the inefficiency and decided to create the Chicago Board of Trade, which is the first formal or first modern futures market. Some businessmen in Chicago saw this as an opportunity and created the Chicago Board of Trade. This is a futures exchange, and what the Chicago Board of Trade allowed was for farmers to lock in a price before they deliver their product. So if the product was to be delivered in the summer, or their produce was to be delivered in the summer, then in winter or in spring, the farmers could lock in a price at which they will sell. Clearly, this benefited the farmers because it hedged against the risk of prices falling, and it helped the party which was buying by locking in prices and hedging against the risk of prices being too high. So everybody benefited and the volatility also came down. There is a little more detail in the curriculum on this, but as long as you've understood what I've just said, you should be in good shape. Now let's look at the specific purposes and benefits of derivatives: risk allocation, transfer, and management. The main benefit of derivatives here is that derivatives allow us to manage risk without trading the underlying asset. For example, let's say that you own a given stock and you are concerned about the stock falling. In a world without derivatives, the only way for you to manage this risk would be to sell the underlying stock or to sell this stock. But if you do have derivatives, then there are several other options. You could use put options, for example. Put options will allow you to make money if the stock price falls. So you could buy an appropriate number of put options to hedge against the risk of the stock falling. You could go short on a futures contract which is based on the stock, or you could take a short position in a forward contract. So the point is that with derivatives, there are several ways for you to manage your risk without actually trading this particular stock. Next point is information discovery. And within information discovery, there are two key elements that you need to be aware of: price discovery and implied volatility. What price discovery really means is that derivatives markets, and specifically futures markets, make it more efficient to get information about the price of a particular underlying. For example, if you are trying to figure out the price of gold, you could go to the spot market, but then the question is which spot market, because the trading of gold in the spot market is very decentralized. So the most efficient thing to do is to look at the futures contract prices of contracts that are expiring as soon as possible, for contracts that are expiring very soon. And that is a very efficient way to discover or determine the appropriate price for gold. The other point is implied volatility. We'll see this in more detail when we study the different kinds of derivative contracts later, but the high level point is this: the price of a particular kind of derivative, let's say a call option, is based on several variables. And if you think about a particular model, let's say that we have a model called the Black-Scholes-Merton model. The way we come up with the price of a call option is by feeding different inputs. So for a particular call option, we'll feed the underlying stock price, the exercise price, the volatility, the risk-free rate, and then this model will give us the value of the call option. Now, if we work backwards, and we know the value of the call option in the market. So a given call option is trading at a certain price. We know the stock price, we know the exercise price, we know the risk-free rate. We can then determine the implied volatility. And the reason it is called implied volatility is that this volatility, and this is the volatility of the underlying stock, is not explicitly known. But we can figure out what is the volatility number that is implied by the price of the option in the market. So derivative markets allow us to determine the implied volatility. Next point has to do with operational advantages. There are three major advantages that you need to be aware of. The first one is that derivatives allow us to reduce transaction costs. And the idea is this. Let's say you want to invest in a fund that is based on the S&P 500. One strategy is to simply go invest in that particular fund where the underlying shares are based on the S&P 500. The other strategy might be to take a long position in a futures contract which is based on the S&P 500. Typically, this strategy of taking a long position in a futures contract is much more cost effective than going and buying shares in a fund which are based on the S&P 500. And both the futures contract and the fund will give you the same sort of exposure. The second point has to do with liquidity. Typically, futures contracts are more liquid than directly investing in a fund. And the final point is that it is very easy to take a short position. Let's say that you have a view that the stock market will go down. The best way to take advantage of this is to take a short position in a futures contract that is based on the S&P 500. Our final point has to do with market efficiency. And we talk about market efficiency in other parts of the CFA Level 1 curriculum. But very briefly, a market is efficient if prices reflect all available information and it is not possible to make abnormal profits over long periods of time. Another way of putting it is that if securities are not at their proper price, then the market is inefficient. Now, what do derivatives do? With derivatives, the transaction costs are lower. It is easy to take short positions. And therefore, if there's any mispricing in the market, derivative instruments allow us to easily take advantage of any mispricing, and therefore the mispricing is removed faster. In other words, derivatives allow us to remove inefficiencies from the market faster and take us towards an efficient market.